figure that. Okay. All right. So basically I try to, understand, the in-depth knowledge of Forex. And when I lost that money, because my wife was like, this Forex that you are doing, are you sure it will work? My wife was really against it because she was not seeing any traction, right? Now, when I lost that $3,000 that day, she was like, do you still want to continue? Naturally, with the natural, mind, one would say this business is not something we should continue with, right? But instead of me to tell my wife that I will not continue, what I told her was I asked her a question. I said, nah, because this is a loss. Now let's turn the table around. If this loss were to be profit, trust me, you will not ask me this question, or will you? She said, no. He said, but it's not profit. I said, yes, because I did something wrong. If I had done the right thing, that negative would have been profit, And as time progresses, I started finding my way, and I was able to, find my way around the market in terms of analysis and being able to place a trade that would lead to profit. And I started making money. And most time when I make money, the first thing to do is that my wife will come and say, I should give her. I say, but this is the same thing that you say is not good, right? I mean, jokingly, we'll joke about it. But the truth is, if you say to yourself you can do it, and if you are really committed to it, you will be able to do it. In my schedule today, in my office, I have some persons in my office in this class. They know how busy I am by virtue of what I do. Now, if in my business schedule, as busy as I am as general manager, I can still place a trade that trade will go into profit. Trust me, it means that if you know what you are doing, you can make money in this market. You can make good money in this market. And like I said, today we are looking at the language of the market, and that language is called candlestick. Okay, candlestick is for me is the only tool, right? Because every other thing that you see in the market, they take a clue from candlestick. Any line you see that is drawn in the market takes a clue from candlestick. Anything you see in the market takes a clue from candlestick. So candlestick is the actual representation of price. Everything you see about candlestick, every level, every position of the candlestick is a price value. It's a price value. Okay. So when you see a candlestick like this, it doesn't make sense, right? Because let's say if I take out this arrow, if I don't put this arrow to show that this one is going up and this one is going down, okay? If I take out this arrow and I take out this arrow, you cannot make sense out of this candlestick, right? Because in reality, if you are looking at your chart, you will not see this arrow, right? Because I put this arrow, it tells you that this candlestick means that the market is going up, and this candlestick means that the market is going down. That's because I put the arrow. If I take out the arrow, you won't be able to tell me which one is going up or which one is going down, except if you have known that, okay, the white color means that it's going up or the blue color means that it's going down, right? So all this point, all this level you see on the candlestick, there are 1, 2, 3, 4, and 5 important aspects of the candlestick. Okay, these 5 important aspects are the high, the low, the open, the close, and then the body. This body is actually the volume. Okay, V is the volume. Okay, so it's very important that you understand this five aspects of the candlestick. You cannot do without it in the Forex market. You can't do without it, because there's a way the candlestick will close. It will tell you the market is going to go up. There's a way the candlestick will close. It will tell you the market is going to go down. Remember, in our last class, we talked about the laws of economics. So we talk about supply and demand. There are only 2 things that drive price in this world. 2 things: supply and demand. Supply and demand. Okay, these are the 2 things that drive price. And if you look at the Forex market, some people will say price does not stop in space, and it's true. Price cannot stop in space. So when we are doing this analysis, what we liken it to is a story building. If you are in a story building and then you are on the top floor, the top floor where you are standing acts as a support, which is like a demand zone, or like a demand zone. Okay, Why? The roof acts as a resistance, which is more like the supply zone. Now, for somebody who is at the first floor, you will agree with me that if the person's weight is more than what that floor can carry, that person is going to drop down. That floor is going to break and the person will drop down, right? That means to say the person is exerting a higher force on the floor, okay, than the floor can hold. And in the same vein, if that person jumps up and he possesses enough velocity to blow through the roof, it's going to go out of the roof. But if his velocity is not, velocity acceleration or speed is not enough to take him through the roof will bring the person down, will bounce down. So there's going to be bouncing up and bouncing down. Okay, so when price hits support, price will bounce up. When price hits resistance, price will come down, will bounce down. But two other things can also happen. It's possible that the price is so strong, the momentum, the speed of that price is so strong that instead of bouncing up from the floor, it breaks through. Okay, and also vice versa, if it goes up, it hits the resistance, instead of bouncing down, it goes through. And if you look at a football, if you take a ball, for instance, and you bounce a ball, if you hit a ball on the floor, that ball will keep bouncing. Now you will agree with me that when the ball bounces the first time and goes up, the ball will go to a higher level. Okay, will go to a higher level. When it comes back and hits the ground and bounces up again, it will not go as high as the previous level it got to before. So by the time the ball bounces like 10 times, you will see that the speed of the ball is going to be dropping. That's exactly what price does. That's exactly what price does in the forex market. So if you can understand this simple explanation, trust me, you have the entire concept of price in your hand. You'll be able to manipulate it. You'll be able to use to manipulate in the forex market. So yeah, in the candlestick, we pay attention. We pay attention to high, we pay attention to low, we pay attention to open, and we pay attention to close. Now, what it means is that when the market opens here, at this point that the market opens, it's a price value. Now, in the process of time, so we talked about time frame, right? We're actually going to come back to MetaTrader 5, MetaTrader 5. Now we talked about time frame. Now, when we talked about time frame, we said we have 1 minute time frame, we have 5 minutes. In fact, we have 1 minute all the way to 1 year time frame. Okay, but then if you select a time frame in the forex chart, you are going to be restricted or limited to working with that time frame. So if, for instance, you take a 1 hour time frame, it means that this candle opens between when the candle open and when the candle close, the total time is 1 hour. So that means if the candle opens by 8 o'clock, 8 a.m. in the morning, by 9 a.m., this candle will close. But in the process of time between when the candle open and close, there's a tendency for the candle to come all the way down here, which is this low. And there's also a tendency for the candle to go all the way to this high. And then eventually came and closed here. So what the candle does, the candle is ticking, right? It does like a tick, 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 tick. So as it's ticking continuously, as the candle is ticking continuously, it ticks and comes here. But it is not 9 a.m. yet. Remember, the candle opened by 8 a.m. By 9:20 is here. So the candle is not going to close. And if the candle does not have enough energy to go below this point, it starts going back up. Now it goes back up, and then come up the way to this high, this level, and it wasn't still 9 o'clock at that time. So the candle continued to tick until it's 9. So why the candle was ticking? Because every ticking in the candle means an up or down movement. Why the candle is ticking both up and down, by 9 o'clock, it was at this point, and as soon as it gets to 9, that ticking for this candle stop and it moves into another candle. That becomes the open of another candle, and that will tick, 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 and go all the way to 10 o'clock. Okay, so this is a continuous process in the market. It will continue as far as the market is on. Okay, and every time the market opens, every time the market closes, there's a tendency that the market will open at a price that is very close to the previous close. a price that's very close to the previous close. And there's also a concept in the forex market that is called effective distribution of price. And that's why we really need to give consideration to the week. Every time the market comes to a low and the market did not close there, because if the market goes back up, there's nothing that will show that the market gets here. So what the market does is it leaves an imprint, which is this wick. We call it wick. Some people call it shadow. Okay, it leaves an imprint. That imprint tells you that from beginning, when the candle opened, until the time the candle closes, the candle made a movement that got all the way to this point, this price level. And then the candle rallied all the way back up and eventually came back down and closes at the point that is called close. So these are the four major features of the candle. Then the next key feature of the candle is the volume. The volume is the total transactions that took place in this candle. So let me paint a scenario. We have so many people that goes to the bank on a daily basis, Monday to Friday, right? From morning till night, people will be entering and leaving the bank, right? People will enter, people will leave, people will enter, people will leave. Now, as these people are entering and leaving the bank, you cannot tell what each and everyone is going to do. You cannot tell. You cannot say, oh, this person that entered the bank now is coming to withdraw. You can't say. You cannot say the person that is coming now is coming to deposit. No, you can't say. That's why the candlestick, you can only know that the candlestick open, but where the candlestick will close, you don't know. The candlestick can decide to go and close below where it opens, and that time we call it a bearish candlestick. So I want you to take this today. The candlestick does not have a name until the candlestick closes. The candlestick does not have a name until it closes. It can open and first of all go bullish and later come bearish and even go bullish again all the way to this up and still end up coming bearish, to a very low level. So that's why I say, as many that walks into the bank on a daily basis, you cannot tell what they're going to do. But everybody that walks into the bank, they are there for a reason. They are there to carry out a transaction. The total volume of everything they do that day is what we call the volume. Okay, is what we call the volume, which is this space that will determine how big this body of the candle will be. If the volume is so much, the candle will be so big. If the volume is so small, this candle will be so small. If the volume is moderate, the candle will be moderate. So this is if you can understand what I just explained to you and you consolidate on it and try to see how this thing work in the forex market, trust me, you will trade in this forex market and you will make money. Why people are shouting that no, people that trade in forex market, they don't make money, they lose money, it's not true. There are a lot of people that makes money in the forex market. If they don't make money, if they are not making money in the forex market, Wall Street should not be existing in the US. If they are not making money in the forex market, Bloomberg as a company will not be existing. Even CNN, they will not. So let's get ourselves out of that, that deception that says, oh, everybody that trade in foreign market, they make loss. Yes, there's a global statistics that says it's only 5% of people that trade. I don't even believe that major in the field, but let me assume I believe it. That yes, okay, it's 5%. You just want to be in that 5%. That's your target. Let's say it's 2%. You just want to be in that 2%. The most important thing is that at the end of the day, you make money. And you see, no matter the amount of money you make in this market, it has no effect in the market. The market does not even know you exist because the market is so big, it's so massive. There's no country that its yearly budget is equal to the amount of money or volume of transaction that happen in this forex market, even in 2 weeks. No country in this world that has that kind of budget. So what does that tell you? And this market will go on all the way for 1 year. It will go to 5 years, it will go to 10 years. Continuously running. So there's a lot of liquidity in the market. So all you need to do is to find your position and enter at that point where you think you will make money. Okay. And let's also understand that according to the theory of economics, we want to buy when the price is low. So if you look at this, I have low, I have high. So if I want to buy when the price is low. If I want to sell, I want to sell when the price is high. And like I mentioned in my first class, I said this is the only business I know in the world where you make money both ways. You can lose money both ways, that's fine. But if you know what you are doing, you make money both ways, and you can make money both ways for a very long time. Okay, so if every time you do analysis and enter the market, you are right, you will continue to make money, except when you are wrong. And one way for you to be able to avoid, making mistake is one, you stick to your strategy. That thing that you have learned, that thing that you have developed, thing that you believe works, stick to it. Don't don't say because Mr. A does this one like this, so I want to go and do more like that. No, stick to it. Okay. And if for any reason you believe that Mr. B analysis is more accurate, switch to Mr. B's analysis. There's no big deal. Okay, and that's why you have a lot of communities online, global communities where you can participate, both in Facebook, in KingChat, in TikTok. You have them everywhere. Okay, where you can gain some useful insight. But the problem is that there are a lot of jargons. There are a lot of unfiltered information in the public space that can lead you astray. Okay, so you need to be able to tell, just like as I'm telling you now, that this candlestick, when it closes above the open, the candlestick is called a bullish candlestick. This is a fact. This is not a theory. We are not subjected to any form of hypothesis or testing. It's a fact that when the market opens at a price and closes above that price, that candlestick is a bullish candlestick. If the market opens at a price and closes below that price, that candle is a bearish candlestick. Now think about it pause for a minute and think about it. A monthly candle or a weekly candle. Remember, a monthly candle will take 30 days, right, for that candle to close. So it means that in 30 days, that candle will keep going up, down, up, down, up, down, up, down, up, down, and then eventually it will close on the 30th day. Okay? Now, in that process of that 30 days, some people can be on 5 minutes chart and they make money. Some people can be on 10 minutes chart, they make money, 15 minutes, 30 minutes, 1 hour, 4 hour, 1 day, even 1 week, they make money. Some will lose money. But now, if you that knows that is looking at this candlestick, you are able to tell that at the end of the day, or at the end of the month, at the end of the 30 days, you are convinced that this candlestick will close bullish. That is, where it will close will be higher than where it opens from. If you have that conviction, you already have the right trend in your mind. And remember, a collection of plenty candlesticks put together makes the big trend in the market. So you can imagine the Forex market, the monthly chart develops a trend, the weekly chart develops a trend, the hourly chart develops a trend, and the minutes chart, they develop trend. But one beautiful thing about this trend is that each of these time frame that I just mentioned, they carry each other like baby. Okay, like the example I gave the other time, talking about the pregnant mother and the child inside her. Is the mother that's carrying the child. So anywhere the mother go, that's where the child will go. Okay, I mean, for all of you that are here now, and for as many people that will join this class as we progress, stick with this class and wait until the day I'm going to take that class, add a larger time frame, control the smaller time frame. Once we do that class, you will see how it will just pop open to you. If you have been strongly with understanding this trend, you will see how it will just be crystal clear. Because there are some things that are principle. There are certain things that they are fixed, but because people don't know, they tend to struggle with it. Okay, because they don't know. But if you know, you will not struggle with it. You will just go there and apply it. And that's what I'm saying. So for this candlestick, I'm sure with my explanation, you understand that the candle have a high, it has a low, it has an open, and it has a close. And then the candle has a body that determines the total transaction that happens in the candle. Okay. So now, we are not just going to say that because this candlestick here is bullish, that means the market is going up. No. Now, when the market is going up, it's going to be a combination of both bullish and bearish candle. But one beautiful thing you will observe is that if the market is going up, you will have more large size bullish candles as opposed to bearish candle. So yeah, you see this candle is big. You see this one is big. You see this one is big. And you see this one is big. So the big candles, they'll be going up. Okay, that tells you that the momentum is stronger to the upside. That's what it tells you. There's also an indicator that is called momentum in this market, and to also guide you to tell you whether the market is going to go up or the market is going to go down. In similar vein, if the market is coming down, it does exactly the same thing. Okay, the candlestick that comes down, you will see the blue candles, they are now bigger than the white candle. So in a downtrend, your bearish candles have higher volume of transactions that happen inside of them, while your bullish candle have smaller volume. Then now another thing you need to note is when the market is coming down and you start seeing bullish candle, those bullish candle, they represent what we call retracement. That is, the market is retracing. Okay, when it says retracing, means that the market, so let's say from this point to this point, if this point to this point is what we call impulsive move, we have there's a concept in the foreign market that's called impulsive move. Okay, so the market just go, let me take here, bam, 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 everything is almost white, only one small blue here. This is what we call impulsive move. Okay, so this movement from this up here to this place, we say is impulsive move. Now, after that impulsive move, the market is going to do what we call retracement. It's going to do what we call rest. It's going to try to rest. Let me see if I can. Let me see if I can. I want to just digress a little bit. Let me just pull out. Let me pull out. Let me pull out one topic. Okay, I took in the past. Just to explain the concept for you. This right here. Forex market. Trend line. Right there. The great circle. Yep. Okay. So these are the first set of slides I created, far back in 2017. Okay, so I just want to explain something to you here. Now, this is the book I told you I bought. Okay, I actually created the slide from it. The book I was telling you I ordered from Amazon. Okay, so if you look at this guy, the guy's name is Sokyu Oma. This is his name, Sokyu Oma. You can go and Google it, and read more about the guy and possibly his book and his financial exploit in the forex market. So the guy developed a process that is called the 5 Sakata methods. 5 Sakata methods. These 5 Sakata methods, they are stages in the forex market. This is the traditional forex market. What you see today in Candlestick is the modern forex market. Okay, but it develops something that is called a great circle. Okay, so this is just a definition of the stages in the great circle. So with the first stage is Sanzan, which means 3 mountains. 3 mountains means triple top. The popular saying today is triple top, but today the most popular in the forex market is double top and double bottom. Okay, but now I'm talking of tradition. This is far back, the early days. Okay, it also created. He said the second stage is called the Sansen, which means 3 rivers, and it's called the triple bottom, which is what we have as double bottom today. Then they have what we call the Sanku. The Sanku is a gap, so triple gap. So it refers to the empty interval between the prices. That is, today is a weekend. Now, when the market opens, there's a tendency that the market will open with a gap. Okay, that's what it's referring to here. Then it's called the Sampe, which means 3 lines. 3 lines means that movement is a continuous movement. So 3 line is more like when the market is trending. And lastly, you have the Sampo, which means 3 rests. Okay, 3 rests is this is the reason why I brought this slide now. So 3 rests means that the market moves, exhausts its ability to move, and then the market pulls back. Okay, and then the market goes impulsive, bam, 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 and then the market pulls back. This pullback is what we call correction, or what we call rest. This is what the man referred to as rest. Okay, so he created a circle, and this is the circle. I will show you the circle in a circular form, and I will show you in this form. Okay, so these two things, they are the same thing. This and this, they're exactly the same thing. So there's saying, so this circle, the market starts from Sanzan. Remember, it says Sanzan is triple top, and we'll call it double top today. So if the market starts for Sanzan, it means that the market takes off. Okay, okay, let's start from bottom. It takes off from Sanzan and then it goes to Sanku. Okay, 1 minute. Let me accept this guy. Some people's network are not very good. They're just fluctuating, in and out. All right, well, let's see how it goes. So it starts from Sanzen, which is a triple bottom, which we call double bottom today, goes to Sanku. Yes, come back.
Question
Yes,
before Zanzan. So what time does the market open and close in Nigerian time zone?
Okay, so there's a global time that the market uses, and it's called the Eastern Standard Time, which is the United States time, right? Okay, now, but because the market trade in zones, and the zones are the US, the EU, and the Asia zone. The EU zone, we have the Europe market and the Frankfurt market. Then the US zone, we have the United States market, and then the Asia zone, we have the Japanese and the Australia. Okay, they are the ones that make up the Asia zone. So now it's easy for you to understand in the sense that the Europe zone, which is a zone that accounted for close to 70% of all the transactions in the forex market, they bear the same time that is close to Nigeria time. That is, when we are going to work by 8 o'clock in the morning, those in the UK, they're also going to work by 8 o'clock in the morning. Okay, and they will do transaction until 5 p.m. UK time. That 5 p.m. UK time, most time is the same 5 p.m. Nigeria time, and most time is just an hour difference. Okay, then so if you take reference from the UK, what I normally do, I take reference from the UK. So that Eastern Standard Time, that America time that the market is going to open, okay, for you to start trading, that time in our time is like 10 p.m. Okay, 10, sometimes 10, sometimes 11. So it varies, it changes. Okay, because of the timing, the global timing zone and all that. So it changes. So it fluctuates between 10 and 11 most times. But then on your chart, I will show you. This is part of some of the things, some of the functions of the platform that you're using to trade is there. You can activate the time, and you want to see the time that each currency pair opened. Now, apart from the generic time, okay, you can also see that for different currency pairs or for different trading instruments, they have different time of opening and closing. So even though they say the market open Eastern Standard Time, it's not everything that open at that time. Okay, but your broker, so the one that is more critical to you is the broker that you are using. Your broker will allow you entry into the market from 10 p.m. Sunday Nigeria time to 10 p.m. Friday Nigeria time, and the market will close. But remember, when we say the market close, it's not that the forex market close. Your broker platform is what will close, because that is more like a global regulation for every broker. Okay, so they allow you 5.25 days of trading in a week. Every week you trade 5.25 days. Okay, then after that the market opens to you for the next week. So in Nigeria time, today is Sunday, right? At about 10 p.m. today, the market will open. Right now, the market is closed. Nothing is happening. So if you go to the chart, if I open the chart right now for you, no activity is going on. Okay.
Okay,
So
sir. Thank you, sir.
Yeah. So nothing is happening here. The market is stopped right now. But by 10, you will start seeing that this candlestick, they will start to move. But take note, this is applicable to currency, it's applicable to stocks, but it's not applicable to cryptocurrencies. Cryptocurrencies trade 24-hour round the clock every day, 365 days a year. Okay. So as I'm talking to you now, cryptocurrency is actually trading. This cryptocurrency, this is Ethereum. Ethereum is trading. You can see it's moving. Okay. I'm on this trade and it's making profit. This is Bitcoin, is moving. Dogecoin is moving. These are cryptocurrencies. Okay, but the standard currencies, because these currencies, they are cryptocurrencies are not tied to countries, right? But these currencies, they are trying to, like this now. This is euro. This is the Europe currency, right? While USD is the United States currency. And it's weekend. They are not doing anything. Nothing is happening. So nobody's in the office. So they cannot be working. It's just like your stock. Your stock will open 8 o'clock and close by 5, right? Every day. Now your stock market, you see that by 8 a.m., 8 a.m. United States time, all the stock in your trading platform, they will be activated, they will be working, they will be trading. Okay. But once it's 5 p.m. US time, those stock activities will die down because the New York Stock Exchange will close. It's not like that for currencies. Currencies is 24 hours once it's open. It runs 24 hours all the way, every time it's trading. Okay. Is that clear?
Yes, sir. Thank you, sir.
Okay, so let me go back to that slide. So this movement that this market is showing you, I want you to see, just like you have water cycle, you have carbon cycle, you have nitrogen cycle. This is exactly the same thing. So it tells you that in the forex market, everything go around one cycle. That is what the market did here. At some other time, the market will still come back and do the same thing. Do you understand? So this market, that this circle that you are seeing here, okay, that indicate the 5 Sakata phases, this is the same thing you are seeing here. Okay. So yeah, this is the legend. This legend shows, so this legend and this alphabet shows you the exact phase that you are in the market. So yeah, as you can see here, this is 1, 2, 3. This is triple bottom. So we are saying that the kickoff point for the market is here, triple bottom. So the market will go and go and go. When the market gets to triple top, it means that all that movement to the upside has ended. The market will find a way to start coming down. Okay, so it starts from triple bottom, ends at triple top, starts from triple top, ends at triple bottom. That's what this cycle is telling you. The market starts from triple top, come to triple bottom, start from triple bottom, go to triple top, continuously forever. That's what the market is doing. Okay, so all these things that you are seeing, so what it's telling you here is that after this triple bottom, what the market does, the market gap. After the gap, the market trend. And this trend, in fact, let me read something for you. There's what we call tree occurrence. Okay, yeah. It's a tree is an important number. It has a somewhat mystical connotation for traders. Many things involve trees. For example, a trend has a beginning, a middle, and an end. Market can have more or less than 3 movements in the same direction, but any trading action taken must account for this triple reoccurrence. This will prevent mistakes and bad trade. So once again, Sokioma appeals to your patience and to the imperative to control our greed. Okay, so this expression you are seeing here is what you are seeing here. When the market starts to trend, there's a tendency that the market will do it 3 times before it stops. So the market moves from this point, from this triple bottom, create the gap, it trends, it rests, trends again, rest, trend again, form triple top, and then it changes direction, came down, create a gap, trend, rest, trend, rest, trend 3 times, create another triple bottom, go again, create a gap, trend. So it's telling you that this is what the market does continuously. And if you take your time, you see those charts that I just showed you, if you take your time to go and look at it critically, you will see that it obeys this sequence. I've taken my time to observe it, to read it. It took time, it took a lot of time, close to maybe 2 weeks, 3 weeks to be able to understand it. You know, I started picking, I first of all started going to the market and look for every place that is a triple bottom. So I try to get the ones that are very accurate, where the market comes to the same price level 3 times. The market came here left, came back left, came back left. That is triple occurrence. Okay. And when the market, even when we try to define our trend, or we try to define our trend, even by our first class, when we talk about the price swing, when the price swing occur, when we draw the first trend line, maybe in our next class we'll do trend line. When we draw the first trend line, we will see that when the market comes back, the market creates a trend line by the connection of the A and the C. Now, when the market goes and come back to that trend line a third time, that is your triple occurrence, and that is where you should be looking to enter the trade to buy or sell. That is buying with an accuracy that is close to 80 or 90% that the market will go in your favor. Okay, so I just decided to touch this. So let's go back to our main slide. Okay, so that you understand, when the market created this big bearish candle, it did this small one, did this big one, did this small one. So this small one you are seeing is that rest that I just showed you in that cycle. Okay, so the only thing that sometimes is missing is the gap. So, but if you really take your time to observe it, you will notice that the market does it. The market creates this gap, and then the market trends. Okay. So Japanese candlestick are used by traders to to identify where the market is doing a U-turn. Every time the market creates, so one thing is candlestick everywhere. Another thing is candlestick formation. Why? The candlestick, they tell the story in the market. They tell you everything that is happening in the market. If you understand the candlestick very well, your trading journey will be a smooth one. So in the market, we have two categories of candlestick. There are some candlesticks that we call indecision candlesticks, and there are some candlesticks that we call decision candlestick. So indecision candlestick are candlestick that tells you that the market is not making any kind of progress. That is, the market is neither going up nor going down. An example of such candlestick is what you have here: the spinning top candle, the spinning bottom candle, the doji stars. These are candles. What it means, remember, we said when the market open, we said when the market open, so this candlestick now is bullish because the color is white, right? So that means to say the candlestick open at this bottom here. But in the process of time, before the candlestick came to close here, the candle got to this low and the candle got to this high. But you can see that the distance between the high and the body of the candle, and the distance between the low and the body of the candle, they are almost equal. And that the candle is called spinning top. If you see the bearish of it, it's called the spinning bottom. Okay, so this candlestick is telling you that the market is neither going up nor going down. So you cannot make a decision with the candle to trade. The same thing with the doji star. This one closes as blue, meaning that it's a bearish candle. So it means that it opens at the top here, it went up, came down, and then closes here. Okay, this is a doji star. Okay, there are a lot of candles. I'll show you how to see a lot later. Okay, then these are decision candlestick. Decision candlestick are candlestick that you will just look at and you say, oh, because of what this candlestick has done, this market is going to go up or this market is going to go down. Okay, so a good example is this full body candles. Look at this full body candle, meaning that from the open to the close, there is no wick. The market did not go and create a separate high and a separate low. So the open and the close are equivalent to the high and the low. These are full body candles. Okay, why the bearish the same, the bullish the same thing. Why for these ones we call this one dragonfly doji. It's a doji like this one. Even though it's a doji, you can see the difference between the wick that goes up and the wick that comes down. You can see there's a large difference, right? When you have a longer wick to the downside, it tells you that the market opens at this point. And the market, exerted so much pressure to the downside. But somehow the market met some kind of resistance. Okay, and the market started going back up. 1 minute. Okay, sorry. So it means that this candlestick gained so much energy to come down, but somehow the area where the candlestick got to, there were so much people that are interested in buying the market. So instead of people, taking profit for the market to be going down, now people are, injecting more trades at this level. And because of that, the market now start to go back up. But because of the time frame of this candlestick, the market could not get past the high. Okay, the market got to this point, and that time, let's say if it's 1 hour, the 1 hour got exhausted. If it's 2 hours, the 2 hours got exhausted. And as the time got exhausted here, the candle closes here, meaning the next candlestick that is going to come is going to experience that push to the upside, because it got energy to come down, but the last energy that it experienced or that it was exerted is the upward energy that the market is going up. So it means that the candle that we open next will take that same energy to go up. So this is a decision candlestick. Now, when you see this candlestick in the market, you don't even need to tick twice. Depending on the area where it's coming from, you can just take a buy here and this market will go in your favor. The same explanation holds for this one. The same explanation holds for this one. The same explanation holds for this one. But the difference between this and this one, we call it hammer. You can see the shape look like the hammer with a long wick to the downside and a little head that you can use to hammer something. Why this one works for the buy trade, this one works for the sell trade. Okay, so this one, this hanging man is bearish version of the hammer. Hammer is the bullish version of the bearish man. Then this dragonfly, this one that you have the long tail to the downside is the bullish version of the dragonfly doji. And this one that you have the long tail to the upside is the bearish version of the dragonfly doji candlestick. So these are names of candlestick, and you need to know them. You need to know this name in your head. Don't worry, you don't need to cram it. As you are trading, you just get used to them, you just know them. It's natural. Okay, there are so many. I have so many of them. Okay, so you need to know their names and what they represent, what they stand for. So we just talk about the doji star. So the doji star is a candlestick. It's an indecision candlestick basically that does not tell you whether the market is going to go up or whether the market is going to go down. But now, beside these individual candles, we are going to also go to what we call candlestick formation. That is combining more than one candle to make a decision. Okay, so we talk about the hanging man, we talk about the doji star. So if you come to the chart, you can figure them out. So in this chart, we are trying to identify candlesticks that are dojis. Okay, so this is a doji candle, this is a doji candle, this is a doji candle, this is a doji candle. These are doji stars. Why? Because the up and the down, the wick to the up and the down, they are the length, they are close. Okay, but when you see that you have that wick and that wick is really, really extra long, like this one becomes the dragonfly. So the dragonfly means that the market will either go up or go down, depending on the type of dragonfly that you are seeing. And also, it also depends on the area where you are seeing it from. If I see a dragonfly, a bullish dragonfly on a demand zone, I don't need a magician to tell me to buy. Okay. And if I see a bearish dragonfly on a supply zone, I don't need a magician to tell me to sell. But when I see a bullish dragonfly on a demand zone, I will be skeptical to take the trade. Sorry, in the supply zone. If I see a bullish dragonfly on the supply zone, I'll be skeptical to take the trade because it's not very convincing, because the zone is a supply zone, meaning that I have more sellers than buyers. Okay, so the definition of supply zone is a zone where you have more sellers than buyers, while the definition of demand zone is a zone where you have more buyers than sellers. So the demand zone pushes the market up, while supply zone pushes the market down. Okay, all right. So just at a glance, you can see this is a dragonfly doji coming from a demand zone, and then it pushes the market up. Okay, this is a dragonfly doji coming from a supply zone, and it pushes the market down. Now, usually when you see these doji stars, when you see this candlestick, you don't need to think twice. Now, sometimes it doesn't matter. Look at this doji. After the formation of this doji, the next candlestick is a big bearish candlestick. But see what the market did first. The market went up, even went above the doji star. Even though it opened from here immediately after the doji, it went all the way, above the doji star, and then it came down massively with a very strong bearish candle and closes below the opening. Now, because it closes below the opening, we say that this is a bearish candlestick. Okay, I don't know if it's making sense to you guys. So it's very important to understand so that's why I told you from the beginning of the class that this is the most important tool in the market, the candlestick. Every other thing in the market, they take after the candlestick. And that's why you see, for people that trade with indicators, if you are trading with indicators, we have two types of indicators. We have the leading and the lagging. So most of the lagging indicators, because they reference the candlestick, their reaction is somewhat slower than the market reaction. So if the indicator is going to tell me that I should sell here, the indicator may not just come and tell me that, oh, I will sell here. The market would have also already moved to maybe somewhere here, and then the indicator is not telling me that, oh, this place is a sell. Why? Because it's lagging behind price. Candlestick is the actual price, the real price. When you say US dollar to the Naira is 1,500, this candlestick, that's what it means. It's a candlestick that gives you that value. Okay? Look at this gravestone candlestick. Look at this one. Powerful, right? Came here, market went up all the way, and then there's a massive push because we have so much sellers that enter into the market than the number of buyers in the market, and it pushes the candle all the way to this point, and this candle closes, and the next candle that follows it is a massive bearish candle. The next one tried to pull back, but because the pressure is down, they push it down. So when the bears are in control of the market, any bullish candle that comes that tries to want to push back, they tend to suppress it. And that's why you have all this. So you see like this pullback, this is a pullback. Now immediately after this pullback, the market creates another gravestone. This is gravestone doji. So the difference between the gravestone and the dragonfly is that there's no wick at the bottom of the gravestone, no wick. While the dragonfly, you have a small wick. This one's also gravestone, a bullish gravestone. Look at it. And see, this is why this market moved from this point all the way to this point. Now, maybe all you need in a year to take care of your family responsibility is just this movement with a one lot. You take this trade with one lot, and maybe instead give it like 3,000 pips, and that gives you maybe like 30,000 naira and $30,000. You just keep that money and use it for the rest of. You can even decide not to trade again for the entire year, and just know that it's only to eat the money, right? So the knowledge is the key. Even though all these candlesticks attempt to try to want to push the market down because there is a strong pressure coming with this gravestone doji, the market rally up. There's a strong pressure coming from this gravestone doji down, the bearish doji. There's a drop. The same thing here, okay? And that's what the market does from time to time. So spinning tops, I explained this one already before. I say you see the body of the spinning top, the wick up and the wick down, they are almost equal. So because of that, it tells you that the market is neither going up nor going down. So the market is not going to move. So when you see spinning top candle, it looks like the market is stationary. It's not going up and it's not going down. Okay. So you see them. This is spinning top, spinning top, spinning top, spinning bottom, spinning top. Now you see the market will hesitate, until something that is decision comes in, and then the market will move. All right, so we're talking about the hammer and the hanging man. The hammer is the hanging man is the opposite of the hammer. So the hammer is for buyers, while the hanging man is for sellers. Okay, so when you see the hammer in a demand area, the market will buy. When you see the hanging man in a supply area, the market will sell. Okay, good example. Now see the difference between the hanging man and the gravestone. You can see the body of the hanging man is a little bit bigger, than that of the gravestone. The gravestone is very tiny. It's just like a T. When you write the letter T, capital T, that's the way gravestone look like. But that's not the way hanging man look like. Hanging man, you see it has, something in the body that shows that there's a body there. But then you have a long wick to the upside. Okay, so the same thing here is the hammer. This is an hammer, this is an hammer. Okay, hammer moves the market up, while hanging man moves the market down. Now, let's come to see how we combine these candles to make decision. So apart from you knowing the candlesticks, the names, okay, you can also, take a combination of this candlestick to form what we call the U-turn in the forex market. So, and this happens a lot. So when you take this is a bullish candle, right? And then this candle is an indecision candle telling you that the market is neither going up nor coming down. This bullish candle is a decision candle telling you the market is going up. This spinning top is an indecision candle. So the market went up and then form an indecision candle that says, I'm neither going up, neither am I coming down. Unless it forms another decision candle, okay, that says the market is going down. This action creates a shape for you, a U shape like this. And so these three candles put together is what you have here now. So when you see this formation in the market, where you have a bullish candle followed by an indecision candle and then a bearish candle, this is a U shape, and the name of this U shape is called the evening star. The evening star. The opposite of it is the morning star, where you are going to have a bearish candle followed by indecision and then a bullish candle. That's the morning star. So when you see the morning star or you see the evening star in the market, it's a decision combination. That is a combination of candle that tells you that the market is going to go either up or down. Okay, so the evening star tells you the market is going to sell. Now, this is the ideal evening star. Now, it can have multiple spinning tops here. This is a realistic evening star. So in the forex market, you're going to see the market gives you a decision candle and then follows by several indecision candles. Now, think about it. If this candlestick we are looking at is 1 month candle, it means that this market took 1, 2, 3, 4, 5 months to tell us that it's going to sell. 5 months interval. This candle can also be a 1 hour candle. And in 5 hours, it has given you a decision to sell. So it depends on the time frame where you find yourself or where you are in. Okay. Both of us can be trading on the same currency pair. I'm trading sell, you are trading buy, and both of us will still be making profits. Because I'm saying something else, you are saying something else in your time frame. Okay. So this is an example of the evening star in the market. You see this market, it went boom, 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 bullish, and then followed by an indecision candlestick that is preceded by a decision candlestick. So this action here is a U-turn. This action these three candles that goes up, indecision, down, is a U-turn. So this U-turn says that the market is going to sell. So you just enter sell from here, and this market will drop down massively, like you have seen. Okay, so this is candlestick formation. We're talking about candlestick formation. Okay, so if you are trading the candlestick formation, you need to know. So there are several candlestick formation in the market. There are so many. Okay, but this company MTI, they did a research, and they said in that research, the result of that research point that there are 5 out of all the numerous candlestick in the markets. There are 5 formation that occur most in the market. So they've done, it was a long, it's a very detailed research that took a long time to do. And after that research, they came up and said there are 5 candlesticks formation that are most occurring in the forex market. And this 5 formation is what we are looking at today. So bullish, we have 5. Bearish, we have 5. So you can even say, oh, right now, I just want to look out for these 5 candlestick. Okay, so the first one is the shooting star. The shooting star is when you have a bearish decision candlestick preceded by, this is more like an hammer. So it's not hammer per se because the wick to the upside is a little bit long. Okay, so this is called the shooting star candlestick, this small candlestick. So it has a long wick that is 3 times the size of the body. It's longer than 3 times the size of the body, and then with a small wick on the upside. So this is called the shooting star. So when you see this from a demand zone, be sure that the market is going to buy. Okay, so this is what we're talking about, the U-turn. So when you see every candlestick formation in the market creates what? A U-turn for us. So the shooting star is a U-turn. So at the opening of the next candle, place your trade and put your stop loss 10 pips below this wick. Just count 10 pips and then you put your stop loss there. And you wait for this market to buy in your favor. Okay, so if you come here on the chart, we are looking for a shooting star. Let me see. Okay. All right. So when you come to the chart, you look for shooting star possibilities. Okay. Is there any place on this chart that shows that we have a shooting star? Let me see. No. So we don't have anyone here. All right. So okay, so basically, all the candlestick formations, you need to understand that they are not formed by just a single candle. They are formed by, so we have the single candle stick pattern. That's the candlestick pattern that is just one candle, which is the decision candlesticks that we know in the market. And then we have the candlestick pattern where you need more than one candlestick to make the formation. Okay. Now, once you have more than one candlestick, we say it's a candlestick formation. And then we'll talk about these 5 that are most occurring. So I'll just skip this. So this is the piercing line. Okay. So we have different candlestick formation that are appearing on the chart. So right here we have the morning star. Okay, morning star given by this bearish candle that came down, followed by this indecision candle, and then this decision candle that went up. So we say from this point, take a buy and the market will go in your favor. Here we have the PSC line. The PSC line is when you have a bearish candlestick. So there's another candle that is the opposite of the PSC line, and it's called the dark cloud. So the PSC line is where you have a bearish candlestick that is immediately followed by a bullish candlestick that goes beyond 60% of the previous bearish candlestick. It didn't go all the way to the up of the bearish candlestick, but it exceeded 50% of this candlestick. Okay. And then when you see that, you take your trade and put your stop loss below the low, and this market will go in your favor. Okay, so this is a bullish piercing line. So the opposite of the piercing line is what we call the dark cloud. That's the name of the candlestick that represents the piercing line. Okay. All right. So for us to trade candlestick formation, there's just a few rules. First, so we should compress the chart and see if the market is in an uptrend. Now you may not understand this now until we do trend lines. Okay, once we do trend lines, you understand this very well. So because if I open the market, if I open the candlestick chart and I maybe zoom the candlestick out, it will not give me a clear, holistic direction, okay, in terms of direction. But when I compress the chart to the minimum, I can see where the chart is coming from. I can see where the chart is going to. Okay. Now, if a signal it's so we have already done the ABCD price swing. So let me just explain this. Already done the ABCD price swing. So in the ABCD price swing, we say the market creates a low that is A and goes and creates a B that is I, then comes and creates a low that is C, which is not as low as the previous low A. Now we say the market is not going up, right? That's our discussion. Now, that point that is C, your expectation as a trader is that you are going to see a candlestick formation at that C level. So this C to D direction, which is the price movement where you are interested, where you want to trade, you will need to see a candlestick in the C area. In fact, that candlestick, it was defines that area as C, that formation. Once you see that formation and it has defined that area for you as C, then you take your trade and wait for the market to go to the D extension. Okay. So if you look at the market, and if the market is in an uptrend, you look to buy what the bullish candlestick formation inside the up AB boundary. Okay. So anytime you see, so what it's trying to say is this. Let me come back to, okay, let me just see. I just push this one up a little bit for you. This. Okay. Yeah, this is our ABC. All right. So this is the ABCD exploded. So this is our A. So let me just bring it here so that you can see it better. So we talked about A, B, C, D, right? We say this A to the B to the C to the D is one price swing. That is one complete price swing in the market. That's what it means. So this A to the B to the C to the D, that is one complete price swing. What you are trying to identify is the C. You want to allow the A to be already formed, then you wait for the B to move to the C, and from there you now trade the C to the D. So what we are saying now, when you get to the C, from this C to this D, you can have multiple trade entries. Okay. So if from here to here, the market gives me a candlestick formation here and I buy, the market is still going, it gives me another candlestick formation, I can enter another buy. It gives you another candlestick formation, I can enter another buy. As many candlestick formation that appears in this place before the market gets to D, you can buy all of them. In the same vein, if it's coming down, the rule is that if the market is going down, so you are going to sell candlestick formation from the C to the D. Now, but take note, that doesn't mean that you cannot trade A to B. And that doesn't mean that you cannot trade B to C. But this screen that you are seeing is not for this class, okay? But it is telling us that there are three zones in this market, three zones in this price swing. These three zones are they are the 50-50 no trade zone, the 90-10 sweet spot of trade zone, and then the 80-20 push zone. Now, what it means, let me go to the next screen and explain it to you. So from here to here is one, impulsive move all the way A to B. Okay. But now, in this A to B, between your B and 38.2 level, we have not done Fibonacci, but let me just mention it, okay? We'll get to Fibonacci. From B to this 38.2 level of the Fibonacci, if you take a trade in that area, there's a chance that 90% of the time you will win your trade, but 10% of the time you will lose your trade. Then below that 38.2 area, let's say you leave the 38.2 and you're not going back all the way down to A. It's where we call the 50-50 no trade zone. It is not advisable to trade here. Most especially, this market is retracing, you want to sell. Don't trade. Don't do anything. Where you want to trade is the 80-20 push zone. That is 80% of the time you will win your trade and 20% of the time you may lose your trade. Okay, so the chances are higher, for the push zone. Okay, so yeah, once the market, once you have understand the concept of Fibonacci, you will understand that as soon as the market creates A to B and the market start pulling back, there are imaginary levels where the market can, do a reversal. This level 38.2, 50, 61.8, 78.6, and 86. These are imaginary support levels where the market can do a reversal. You are not seeing them with your naked eyes. That's why in this second instance, we say do not trade it. Okay. But now, when you want to trade it, you want to trade it in the direction of the push zone. You don't want to start selling here. No sell. Don't attempt to. Because one massive candlestick can just come back that would wipe everything that you have traded. So yeah, you come here and you watch for the candlestick formation and you start trading. So now when you start trading here, any formation you see in this direction, keep taking it. That's what this chart is telling you. Okay, that's what this chart is telling you. Any trade. So let's say this is your C, and it's moving from this C to D. Now, here it created a money star. Here it created a PSC line. Here it created a PSC line. Here it created a money star. So everyone that it creates like that, you can take it as an opportunity to add to your trade. Okay. So first you need to identify if the market is going up or it's going down, and then you start, looking for the formations that favors that direction that you have already identified. Okay, so yeah, we identify the point A and B, and then the market pulls back to give us C, and then the market will start buying. So how did the market start buying? Look at your C. Look at your C. Okay. So when we identify the C, now there are instances like this one that I'm showing you now, where the market comes, this is your A, this is your B, but between your B and your A, the market is meant to identify C. Now there are instances where, so if I say this candlestick is a PSC line, and then I buy the market here, my stop loss is meant to be below the A. Remember, A, B, C, D. So if this is my C, my stop loss should be below the A. But now there are instances where, even though this is your first C, and the market now comes and take out that C and goes below the C, create another C. This is another C, right? Because this is a decision candle, indecision candle, and a decision candle. So this is a morning star. This is a PSC line. This is a morning star. Okay. And then the market comes like this, goes and then come back, down to this your C area again. Okay, because the market created the first C here, and this one invalidated to give you the next C. It comes down again and gives you another C that is lower than the previous C. Now, all these C's I'm talking about now, in as much as they did not come all the way to A, this market has no choice than to go in your favor. The market will only be invalidated when this market comes from B and came all the way to A, and then it takes out the A. There's a rule of thumb, a slogan that we use in Forex. We said, if the market does not take out the A, the market has no choice than to go your way. Okay, all you need to do is patience. So for somebody that entered the market here and the market has gone like this in his favor, and then came back, with this massive speed, thinking that it's going to, take you out of your trade, but it didn't. It did it again 2 times. Sometimes it can do it up to 10 times before the market will eventually go to the D. Okay. And then you start measuring your D using Fibonacci. By the time we complete the concept of Fibonacci, you will start using Fibonacci as your limit tool. That is, your Fibonacci will be the tool that will tell you when to leave the market after you enter. Okay. So it is important that we understand what the candlestick. So that's for the bullish. Then for the bearish is the same thing. So the opposite of the shooting star that we have is we have the bullish shooting star. Then this is the bearish shooting star. So you can see the candle has a long wick to the up, and then a small wick to the down, and a small body. What qualifies it as shooting star is if this wick is longer than this body more than 3 times. Minimum should be 3 times the length. The length of this wick, this long wick, must be 3 times. By the time you put this one, 2, 3, you join this 1, 2, 3 times, it should not be as long as this. Then it qualifies to be called shooting star. So you have a big decision candlestick, and then you follow by this. This becomes a U-turn. The market turns. Okay. All right. So that's the shooting star, the bearish shooting star. It's at the opening of the next candle, take the trade, place your stop loss above the wick. So this is an example of a shooting star. Okay, this is a bullish candle, and then immediately followed by a candlestick with small body, long wick, and a little wick protruding on the opposite side. So you say sell the market here, and this market will run way in your favor. Remember, this is your A, this is your B. The market pulls back. Now, before the creation of this shooting star, there's a tendency that I would have said this bearish engulfing candle is my C, and I place a sell here. In as much as I place this sell, it's not a problem. I can place this sell, but then I should place my stop loss above the A. If my stop loss is above the A, trust me, this market, if it doesn't take out the A, if we have no choice than to actually go your way. Okay. So just like we discussed before, this is the bearish version of the shooting of the evening star. Okay. So this is the ideal situation, this is the realistic situation, like I mentioned before. So you have this, okay, and then you come to the market, you see this. This is the dark cloud. I said the dark cloud is the opposite of the piercing line in the bullish term. Okay. So this is the piercing line. When you see it in the market and it's coming from a remarkable area of demand or supply, then you need to take your trade. So you want to see this from area of supply for it to make sense. If you see it in area of demand, there's going to be a tendency that because we have more buyers than sellers, and the market will not go in your favor. Okay, so that's the piercing line, and you see some example in the market. You see here, this is a piercing line because this bearish candle is more than 60% of this bullish candle. This is a piercing line too. Okay, and you see how they move the market down. Then we have the engulfing candle. We have the bullish engulf, we have the bearish engulf. So you see, this market came up 1, 2, 3, and then only this one took out all the move that, let's say this is 3 months. 1 month, 2 months, 3 months, and just 1 month wipe out the entire 3 months. Okay, so this is what we call engulfing candle. So the engulfing candle is a bullish or bearish candle that has very little wick to the up and the downside. It's different from full body candle. A full body candle is called a Marabozu candle. Maraboz is a candle where there's no wick to the up and there's no wick to the downside. Okay, sometimes you can have some Marabozu that have very little wick, okay, to the down or the upside. So this is a bearish engulfing candle. The opposite of this is the bullish engulfing candle. Okay, so this is the way it works. The market moves and then boom, it engulfs the previous candle, and the next thing the market will change direction. So you see this market, The market creates your A, creates your B. The market start to retrace. This is retracement. And then all of a sudden, you see this bearish candle that engulfs the previous bullish candle. Now I will say, place your sell here and take all this profit in your favor. Okay. And if you look at this place right here, you will see that this is a bullish candle followed by indecision, then a bearish candle. So this is an example of what? Evening star. And you sell after the formation of the evening star, and this market will go in your favor. Okay. So we'll talk about the spinning, we'll talk about the tweezer top and the tweezer bottom. So tweezer top and tweezer bottom candles, they are candles that it doesn't matter the color, it could be bullish, could be bearish, but then they are weak. Two candles that they are weak are coming from the same price level, almost the same price level. So you see this candle, it came from here. And then this one too did the same thing. These two candles put together, we say they are tweezer top. If it's the opposite, we call it tweezer bottom. Now, this tweezer top and this tweezer bottom, they have a tendency to move the market massively. You know, really, they rarely occur, but whenever you see them, and like we said before, this is the ideal situation. The realistic situation can just be something like this. Even though you have all this indecision in between, you can still have these two candles forming a tweezer top, even after a long space of time. And if you see have that same effect of pushing the market down. Okay. So the tweezer top and tweezer bottom, they are very powerful. They rarely occur, but whenever they occur, they do magic in the market. See, this is one good example here. Okay, you see these two candles, they came from almost the same price level. And then you see what happened, the market crashes all the way down. If you see the bullish opposite of it, it will also do the same, the same thing to the market. So these are the candlestick, the 5 most occurring candlestick that we talked about. These are the bearish version. We talk about the shooting star, the bearish star, the dark cloud, the tweezer top, and the evening star. Okay, let me stop for say 5 minutes of rest. Let me take water. I'll be back.
Hello, somebody there? Hello, Mr. Patrick. Mr. Patrick, are you there?
I think it's network maybe.
No, he said he wanted to take 5 minutes of rest to take water.
Okay. That's cool. That's cool.
Okay. All right, guys, let's continue. Can you hear me?
Yes, sir.
Sure.
Yes, sir. Thank you very much. Thank you very much. Really enjoying the training, sir. Thank you, sir.
Thank you
All
very
right.
much.
So this candlestick, they do the magic in the forex market. Okay. As to, you enter the trade and you are able to stay on the trade, or you're able to make money on the trade or from the trade. So that's what they do for you. So this is just to identify some of them, and how well we're able to trade them. Okay. And that will basically bring us to the end of this class. So tips of traders are one of the most important things to remember is that candlestick formation represent what? Turning point or U-turns in the market. They are typically found at the A, the B's, the C's, and the D's in the market. Now remember, the A, the B, the C, and the D is our price swing. So we can, every point in the market, there must be something. Just like we said, the market price will not just stop in space, right? And price cannot just continue to move. Something must cause price to stop, and that is the U-turn. Okay, and they are usually what the candlestick formation. Remember, the candlestick represent a lot of things. There are a lot of psychological activities that goes on inside the candlestick, but then you need to understand, this concept and be able to recognize them on the chart when you see them on the chart. If you're able to recognize them on the chart, then you are good to go. So that brings us to the end of this topic, candlesticks. All right. So on your own, you can just go to, let me say, go to Google, for instance. I'll just give you an example. You can just go to Google and type candlesticks. Right? It's going to bring out, it's going to bring out several candlesticks for you. Okay. You have people that have developed a lot of it, and they are everywhere. They are everywhere in the internet. Okay, so many of them. Okay, I love this one. Okay, this one. This one is from Wise Trade. Okay, there's a course I took in Wise Trade where they gave me access to this document. Okay, so all these are all candlesticks. So you see, this is a pattern. This is a pattern. They're everywhere. So if you take your time and say you just want to even learn candlestick by coming to Google, just to master the different type, there are so many. There are so many. Where I took that presentation from the last time, I have something on candlestick, and it's about, how many pages? Let me see. That's a lot. So these are different type of candlesticks. A lot of them. You see? So you see their name. There are so many: spinning top, stud pattern, stick sandwich, takuri, Tasuki gap, three advancing white soldiers, three black crows. So there are so many, right? Now, but what MTI has done as a company is to reduce the complexity of you having to identify all these candlesticks and say, look for these five. These five are the ones that occurs most in the market. So if I take you to the forex market, so let's go to the most traded pair in the whole world, Euro USD. This is Euro USD. This is the most traded currency pair in the whole world. Okay, remember I said Europe account for 70% of all the trades that happen in the forex market. Okay, so this chart that you are seeing, this is Euro USD. This is what happened. This was what happened last week. Okay, this was NFP. I don't know how many of you know NFP. NFP is the number of jobs that the United States creates on a monthly basis, and every first Friday of the month it is released. So this candlestick was first Friday of this month, this very one. And that was you know, brought the market down. Okay. No, I think I'm wrong. Sorry. It's this one. It brought the market, it took the market up. Yeah, sorry, I was correct. This okay? Let me put a line there. After the figure for us right there. Yes. So you can see the dates. Okay. So what it tells, what this thing means is, so this is Euro USD, right? Euro is the base currency, USD is the quote currency. So this value you are seeing here is the amount of the quote currency that is needed to get 1 unit of the base currency. So if I switch it to Naira, let's use Naira, our currency, which is faster. So this is Naira. This is USD, United States dollar and Naira, okay? So this is USD NGN. So it tells you that I need 1,504 Naira to get 1 USD, okay? That's what it means. Okay, so now, this is your trading platform. This is the trading platform that we used to trade. So let me go back to Euro USD again. Okay. So this is trading platform that we use to trade. This is where you make the decision of whether to trade or not to trade. Now, what we are doing, the course that we have taken today is the candlestick. So this is the candlestick, right? And we talked about Doji Star, right? We talked about Dragonfly Doji in this class. And here is one that moved the market down. Can you see that? Bullish candle up, Dragonfly, market come down. Okay. So if I leave this chart and, if you look back and forth in this chart, you will see all the different type of candlestick we have talked about today. You will see them on this chart. And you will see why the market went up in that direction, right? The last one we talk about now, we talk about bullish engulf, bearish engulf. And you see this market came back 1, 2, 3, and then boom. This bullish engulfing candle engulfs these 3 candles, and it's the reason why the market went up like this. You will see it crystal clear. It's not magic, okay? And you will enter the market and you will make the money and you will close the market, okay? So if we just keep scrolling, you on your own, you can identify some of this pattern, and why they occur by just looking at the chart. So the knowledge gain is this. So I might come here and I look at this place and I say, oh, this place is a low, right? This is a weak. I'll just put another this thing and move it to the body and say this is the candle body. So this place, this space between these 2 lines is what we call the demand zone. So what I would do is I'll now say anytime the market comes to that zone, to this zone, now the market comes to this demand zone again after a long time, okay? And it came to this demand zone, and then while I'm looking, I see that the market created hammer. This is one, this is another one, okay? Created hammer candlestick in the demand zone. I don't need to waste time. I'll just take a buy. And that's why this market ran all the way up. Okay. Last week, we talked about our past resistance become support. And as this market is coming down, each of this place like this, let me identify it for you. This market here, this is a resistance. This is a resistance. This is a resistance. Are you seeing it? This is a resistance, but because this one is higher than this one, I'm not going to take this, because if I'm standing in the front of the market, I will not see this. I will see this, but I will not see it because this one is covering this one. So these are the valid resistances, right? For this area that I'm analyzing now. This is another one. Okay, this is another one. All right, and then this is the last one before the market started going up. Now, what I want you to know is look at this place. Look at this resistance. How this market breaks this resistance and came back to exactly this resistance here. Yeah. Can you see the candlestick pattern there from what we have learned today? This is a bearish candlestick down. This is an indecision candlestick, and then this is a bullish candlestick up. This is a morning star formation. Morning star. Let me see. Here's the circle too. Circle. I can draw a circle here. Okay, why is circle showing line? Did I click the right thing? Sorry. Circle. Oh, this thing is not working. Okay, circle has turned to line. It is well though. Okay, so I mean, just to explain what we learned in the class now. This is one. This is a bearish candlestick. So I want you to take note of this. You already know that in the past, this place was a resistance. And then the market came back to this place, break through it with this big candlestick. And in our last class, flip it back to our last class, we said when price break through resistance, there's a tendency that that resistance will become support. That's why we have the concept of past resistance becoming future support. So this was the past resistance, and here is a future support. Right now it's a support, okay? So because this place is a support now, I see a morning star candlestick formation here, and I just place a buy trade here. How do I place the buy trade? I will come here and click on new order. When you click on new order, it will bring for you this dialog box. So you have the option to say buy and you have the option to say sell. For you to buy, you need to first of all determine what volume of your money do you want to expose this market to. That's where you need to come here and choose between 0.01 and to a maximum of any number you like. You can come here and type 20 and say you want to enter the trade with 20 lots. It's up to you, depending on how much you have. But there's a value you will put here. The value will be bigger than the amount in your account, and it will not allow it. Okay, so you need to take your time to know the type of lot you are using or you are applying to taking your trade. Okay, so when you put the lot size, say I put 0.01, these two buttons will be highlighted. What do I want to do? Do I want to buy? I say buy. Do I want to sell? I say sell. But before I place my buy and sell, because I am trading here, because I want to trade from here, Now, I want to put my stop loss below. Let me remove the other line so that we don't get confused. So Control B, take out all the lines, and let's put only the one that we are using. So we'll put only this one. And then we'll say we'll take a buy from here, right? We'll take a buy when this is the candlestick that complete the morning star, this bullish candlestick. We'll take the buy from here. But now your stop loss needs to be below the low before this place. The low before this place is here. So my stop loss is going to be here. So this becomes my A, this is my B, and this is my C. So if I put my Fibonacci 2 between my A and my B right here, from here, this place came to, are you seeing this yellow line that this candlestick touches? This one. This is what 78.6. Now, if the market pulls back to 78.6, the market will naturally go to 127.2. Now, as at this point when I was entering this trade, I didn't know that this market will get here. But I said, okay, I'm entering from here, so I will take my profit at 127.2. I will come here and put take profit here. How do I put the take profit and how do I put the stop loss? Right here. When you click on this, your order button, okay, and you want to buy, you can come here and click on your cursor so that you can see this line. See this line that is moving to and fro, right? So I want to put my stop loss here. I will put this line here, and I look to my right. Look at this line to my right here, this place here. So when you look to your right, that value that you are seeing there is 1.6452. You will come and type it here. Stop loss. Okay. Once you have typed it, you go to the take profit because the market hits this 78.6 level. My estimation is that the market will go to 127.2. I will come to this 127.2, which the value is already there. Okay, 1.11090, and you will not type it here and take profit. Once you have type this, put your volume, you click buy. As soon as you click that buy, it draws 3 lines for you. Okay, it automatically draws 3 lines for you. A line that represents the stop loss, a line that represents your order, and a line that represents your take profit. Now, once you have done this, you can go to bed. You can travel. You can go anywhere you want to go to. No need to think. Just go. When this market moves, it moves from this point. Now, from where we enter now, it did 10 days to get to 127.2. In 10 days' time, you may not even be looking at your computer. But after 10 days, this market gets to this point, automatically, it closes the trade and put the profit into your account for you. Maybe you came back after 15 days or after 20 days. You will see that that trade that you put has already made profit, and the profit is already waiting for you in your account. Okay, so this is how we use Fibonacci. Don't worry, by the time we do Fibonacci class, you understand it very well. It's very simple. But from a distance, it looks very complicated because of the way people blow it up. Okay. So once you do this, you are good to go. You take your trade, you rest your case, you come back, the market is in profit. Where people have problem is most time when they put the trade, they will be looking at the chart, looking at the chart, looking at the chart. Like I said, this chart is a daily chart, right? And this daily chart means that every candlestick here takes 1 day to open and close. From the opening until the closing is 1 day. So the opening of this candle to the closing of this candle is 1 day. The opening of this candle to the closing of this candle is another 1 day. So all this they are seeing like this. So you can see it is 1 day, 1 day, 1 day. So from year to year, it did like 1, 2, 3, 4, 5, 6, 7 days, and then it did one bullish candle against us. Now, because the pressure to the down is high, even though it creates the bullish candle and you think that the market is going to start going up, it didn't. Okay? Because the pressure is a stronger bearish candle came and pushes the market even further down. And that's why I see that the market did all this movement to the downside. By the time you understand it, you see that it's so easy, and you can do it anytime. And because this is daily chart, like now I told you that this market will open around 10. Okay, by 10, once it's 10 o'clock, this market will open, a new candlestick will start forming. Okay, now when it opens, I can make all my decisions to trade right now for this week. I can look at, okay, let me put something that can give me I can flip the chart. So let me just put one indicator here. Yeah, I use symbol changer. So if I put this indicator here, it shows me all the symbols on the chart. Okay. All right. So these are the symbols. So I can easily say Control B, take out the lines. Okay. When I click any symbol here, that's what will be showing on the chart. So I don't want to start going to look for how we change chart. So I just come here. Anyone I click, that's what will show. Okay, any symbol I click. So this GBP USD, this Euro USD, this AUD USD, this, Euro card, like that. So I can sit down here now and make all my trading decision for this week. And I place the trade. And I go to my work tomorrow till Friday. I might not even bother looking at the chart. Okay. Maybe after 7 days, I come back and look at the chart and I've already made profit or make loss, depending on depending on how accurate my analysis, of taking the trade is. So you can develop a trading style. So your trading style, you can develop trading style that we work with your current work, such that your trading activity will not impact your work that you are doing. So if I take a trade now, the next time I will look at the chart, because I'm looking at daily chart, will be 10 p.m. tomorrow night. I've already closed from work. I'm not at work. Do you understand? Why some other persons may choose to say, no, I go with 4 hours. Every 4 hours, a candlestick is formed. Every 4 hours. So every 4 hours, the person comes to look at this chart. It means that this person will look at this chart 6 times in a day. 6 times in a day. Okay? That, if you are doing that and you are working, you can be getting some distractions. Have you seen the gap that we are talking about? That we'll talk about just now in the trade. See an example of the gap here. This is an example of the gap. So the market creates a triple top, creates a gap, trend, then rest, then trend again, then rest again, then trend again. So is this not a replica of that thing I explained to you, in the class just now? This is a replica of it. If you take your time, you will see everything that we're talking about. So let's take some questions before we close. If you have questions, any area that you are not clear with, it's already 10. So does anybody have any question to ask before we close the class tonight?
I wanted to ask, my name is Martins. Can you hear me?
Yes, go ahead.
For the last class, the recorded section, you said you were going to put it on YouTube. I don't know if that has been done, because
Sorry, I've not done
we
it.
do we do the class once a week, and for those that basically are new to it, sometimes it's good for us to get a refresher on that even before the new class.
Okay, very good. So let me do something for you now. First, I want you to do this. Let's go to baby pips. So I want you to go to this site. Okay, this website. Look at the name of the site, babypips.com. I'll just copy it and put it on the chat room now. Spy chart. For everybody. So go to this website. All right. So this website will guide you in terms of trading. When you come to this website, go to Learn Forex, then look for School of Pipsology, and then you click Start Learning. Now, this will take you through some of the parts that I skip. Like I told you, I'm not going to do all the nitty-gritty, okay? All this, what is Forex, what do you do now? This will take you through all those parts, okay? Before it start bringing you, to what we are doing. We basically started from here, support and resistance, and now we are in Japanese candlestick. So Fibonacci is on the way. Moving averages are indicators. So there's a way it's structured. Okay, so if you come here, if you follow this structure and you are able to get all the way to the graduation of this class, there is no way you will not understand what we are saying. And one good thing about this site is that it is very interactive, very interactive. Okay, just take the lesson, take the quizzes, and just use it as a guide. Okay, then there are some materials I will share. Okay, so what I will do, I think you guys can leave your leave your phone number on the chat room. Let me see how I can add you to my WhatsApp group. Okay. Usually what I do is when I finish training people, I add them to the group, but I can add it to the group right now. At least you're because what I try to do is I try to put people that have, idea of trading in the group, okay, so that we'll not just load the place with everybody. So normally my rule is that when I finish the training, you've gone from the beginning to the end of the training, and then you have some good understanding of the training, then I put you in the group. Then you can ask any question you want to ask. You can feel free to contribute, So what you do, just everybody, you can go ahead, drop your phone number and your email. Okay, I'm going to send you, for those that will drop email, okay, so even if you drop the phone number, I will drop all the materials on the WhatsApp. Okay. I'll drop all the material on the WhatsApp. And just for you to also know, let me show you this same class that you are taking now. Okay, I took it 2018. And for your information, this is the manual of the class. Everything I'm teaching you is here. Everything is inside this manual. There's nothing I have said that is not inside this manual. But you know what? This manual that you see is 2 days. I did it in 2 days. Day 1, day 2. Day 1 is, okay, you can see, let me show you the topic. So day 1, these are what we took for day 1. What is Forex? Game of support and resistance, Fibonacci numbers, extension, retracement, equity management, blah, 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 Japanese candlestick. Day 1. Then day 2 starts from here. Consolidations, reversal, King's Crown, strategies, blah, blah, blah. So this 2 session for MTI is 7 hours. 7 hours day 1, 7 hours day 2. Your $10,000 is done. There is not left for you to go and consolidate on the knowledge you gain from these 14 hours of training in 2 days. This was how I learned my own. And it's this training that I learned far back 2018. That's what I'm still using to train you now. That's what I'm explaining to you. Okay. So I will drop this on the WhatsApp group. Once I put your number there, you can pick it from there. I might not be able to send it to everybody one by one. It's a lot, but everything I'm teaching is right inside here. Everything. There's nothing that is not here. Look at it. Just look at it and see if you are not familiar with everything here. Everything is here. It's just that I made it a slide. Remember, this was the key, the 2 finding support and resistance. This was we've done this already, right? High of resistance, low of support. This is the definition. This is how you find it in the market. Okay. So once I put you in the group, there is a price swing. Talk about price swing down, price swing up. Everything is here. But the book is big. And like I said, it was 2 days. I did it in 2 days. I said in 2 days. So for me, that 2 days, was I able to learn everything? The answer is no. I couldn't. But what did I do? I had to go and consolidate on this knowledge, by intentional studies. I was intentional about it. I was determined to know it. I was not the only one that attended that class. But I can tell you that 80% of those that attended that class are not trading today. You understand? So it requires your intention, your effort, your commitment. And once you have known it, like I said, you have known it. That's all. There's nothing, and there's don't worry, there's a point we'll get to in this class, and I will show you some beautiful application of this knowledge, and now you can use that to make money really, really fast. Really, really fast. There are we have so many traders, so many brokers in the world, and all these brokers, they offer different things for you to be able to trade. Different things. And some of them are, conventional trading approach. Some have a particular way that they want you to trade. But the beautiful thing about it is if you understand this training and you're able to apply it, then irrespective of the nature of the market, you can trade. This is what I was trying to describe for you now. Past resistance becoming future support. This is what we're talking about just now on that chart. So nothing learned here that is lost. Okay, and there are several other materials. These are premium materials. This manual, you cannot get it except you attend the Ultimate Traders course of the MTI. They don't give it to anybody. They only give it to those that attend the course. You understand? So, but I mean, what am I doing with it? You can share it for everybody. You can go and learn it, grab it. But then you need to attend this class like this, so that when you are reading it, when you are trying to study it, it makes sense. I'm sure that if you come to this school of Pixology now and you see support and resistance, like this, see support and resistance here. Let me click on it. See support and resistance. Okay. It will make sense to you, right? So what is support and resistance? So let me click it. So look at it. What is support and resistance? You just come and read through all this. This one is not video. This one is, you have to read it. You can see this is your A, your B, your C, your D. Your A, your B, your C, your D. Your A, your B, and now the market is looking to find the next C. From there to go to D. Now, if this market cannot see C, and the market come all the way and breaks below this previous A, as soon as the market breaks it, it tells you the market is not changing direction. All these are things that by the time we finish this course, you will understand it perfectly well. So let's go ahead, drop your phone numbers, drop your email. I'll see I can. Okay, yeah. Okay, I see. Okay, good. So I will just take your numbers, then I will add you to the group, and I will drop the manual there, and you can have it. Every other materials, you can have it. Okay. All right. Any other question?
Hello, sir.
Yes. Go ahead.
Hello. The book you mentioned earlier,
Yeah.
is it The Secret Code of Japanese Candle?
Yes.
Can you please show the front page, the cover page?
Let me. It's my video.
Because I'm trying to have a look at it on Amazon.
Can you see it?
Not very well. Oh, yeah, I got it. Thank you, sir.
All right.
I got it.
So once you go to Amazon, you just see it. It's a very nice book.
Yeah, it's there. I got it. Thank you, sir.
Okay. Any other question before we draw the curtain? Okay, so in the absence of any other question, we'll close the class now. I will see, maybe, I'm just thinking, since on Tuesday is public holiday, if we can schedule, I'm just trying to see my schedule. Tuesday. Okay, well, if there's going to be a class, you will see it. I will drop it. I will try to add your numbers on the WhatsApp tomorrow so that I'll drop the message there for you guys. And also, you can check my Facebook or my Facebook group. I'll always drop it there if there's any class. Okay, so let's see how this will go for us. So
Please
so
link
much
to
for
the Facebook.
come back.
Link to the Facebook group.
Okay, I think I'll just drop it here. Let me see if I can do that. Let me take it from the web.
Okay, it's your name.
Yeah, it's my name. If you just type my name, you see it.
It will come up. That's fine. I got it then.
Okay. And so everybody, let's just take it. So if you just go to Facebook, type my name, you see it. I think it makes my full name. So you can see my full name
Yeah,
here.
it makes sense.
Yeah.
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 That's cool.
All right. So in the absence of any other question, thank you so much for attending this class. Let's do this again. Maybe Tuesday or then Sunday. All right. Have a wonderful night.
Thank you very much, Mr. Patrick.
Thank you.
Thank you very much, Mr. Patrick. Thank you very much.
Thank you very much, sir. Well
Thank you.
Thank you
appreciated.
very much, Mr. Patrick.
Thank you.
Thank you very much, sir. God bless you.
Thank you. Stop recording.